Gold is up and oil is up. Good morning, I'm Joe Doe reporting from the NYMEX. Oil prices are gaining as the EIA Petroleum Status Report showed a build in crude oil inventories by 1.6 million barrels. It was a little bit less than expected. We were looking at about 1.7 million barrels. Here to talk to me about that today is Cindy Wexler. She is an energy trader here at the NYMEX, an independent energy trader. Cindy, thanks so much for being with us. Let's jump right into it. We saw these builds. Are you expecting any sort of bottom anytime soon with WTI crude prices?
I actually don't. I think that what we're seeing today is a little bit of a pop on the inventory number. We also had a pretty bullish number for heating oil and RBOB, which is, I think, driving the market up as well. But I don't think that we're going to see it trade much higher. I think we have a situation where we have really surplus supplies. We don't have, we have pretty lackluster demand. We have all of the geopolitical situations that have been driving the market higher, seem to have been moderating. Syria, Iran, we have Libyan oil coming back on. I think this market is going to continue to head lower.
Well, let's turn to nat gas then, something you focus on a bit more. We have also continued to see builds in inventories, maybe a lack of demand. What's going on in the space, and is this kind of moving in tandem with WTI?
It actually is moving in tandem with WTI at the moment, which is unusual. It doesn't always, but they both have sort of the same scenario of an oversupply and a weak demand situation. So I do think we're going to see natural gas prices head lower as well.
So in that space, what should we expect, at least through the end of this month?
At least through the end of this month, I think we will see maybe $92 in crude oil and maybe $3.30, $3.35 in natural gas.
All right, Cindy Wexler, thanks so much.
My pleasure.
Turning to the gold space, gold prices are actually moving higher as a number of traders look to be possibly short covering. We do have an ECB policy announcement that comes out on Thursday, and then we also have the United States labor report that comes out on Friday. Here to talk to me about a little bit of that is Marcus Grubb of the World Gold Council. Marcus, it's great to have you in New York from London today.
Good morning, nice to be here.
So Marcus, you're a buy and hold type of analyst, and you point out buy and hold in terms of gold investments is really key for people who are, trying to get into this space. Now, what should they be looking at if they're buy and hold investors when they're assessing the United States employment situation month to month?
Yes, I think that's a great question because right now it's that has been driving a lot of markets. What we expect in terms of Fed tapering, the unemployment target of 6.5%, where the new Yellen Federal Reserve is going to take monetary policy and quantitative easing in the next year or two. And I think when you look at that, it's one of the first arguments why gold is a good asset to have in your portfolio, because although we know tapering is coming and extraordinary measures are going to end soon because the economy is starting to gather pace, at the end of the day we're going to see pretty easy monetary policy for a very long time to come. And we don't believe you're going to see much of an increase in interest rates in the next few years, even if the Fed tapers quantitative easing, and that has been delayed into next year more than likely. So we ultimately see that real rates and real returns on short-term interest rates on cash and on bonds are going to be pretty poor in the next few years. And that, for us, is one key argument why gold is still a very good asset to have in your portfolio.
Marcus, your comments on the Fed, obviously a very tight focus for many traders and investors. The question is not if, but when the Federal Reserve does begin to draw down its quantitative easing program, that will be the beginning of what eventually becomes a raise in interest rates. Now, this could be well down the road, but you're talking about long-term holders of gold, and so that would suggest that down the road, whether it be 5, 6, 7, or 8 years, eventually the value of gold is going to be going down. So, how do you kind of advise people with that situation?
Yes, well, we don't think that is the likely scenario. We think that, first of all, rates will go up gradually over time, absolutely, as the economy strengthens. But the first point there is that if you look at the history of gold back to, say, 1971, when gold freely floated at the end of the gold standard, there have been periods of time where gold went up in price at the same time as interest rates were rising in real and nominal terms. So the first point I'd make there is that it isn't a zero-sum game, that if interest rates rise and real interest rates increase, that gold will go down in price. There are periods in history where that's not the case. It really depends on the speed of the rate rise and the extent of it. Now, if we return to a Volcker-style Fed, like we had in the 70s and the 80s, that would be negative for gold because you'd have a high real interest rate. Interest rates would be put up way above the rate of inflation. Our argument is that however strong this recovery is going to be, and it'll be weak compared to history because of all the debt and all the structural issues in the economy, that in fact the real interest rate is not going to rise very high even as the Fed tightens. So we think gold will still be able to deliver a positive return in real and nominal terms, even with a return to higher interest rates,
Sure.
that it isn't a zero-sum game.
Sure, but in the event that, or when we finally do see this move towards a much stronger economy and the Fed pulling back and kind of moving back towards normal interest rates and not moving into quantitative easing, I mean, what's the point at which buy and hold investors in gold do have to figure it's time to sell, at least a fraction or a large part of our investment?
Well, I think that to some degree that has already happened. I think the story of this year is exactly that even though we haven't seen much of a rise in short rates at all, we've seen a rise in bond yields and we've seen discussion of tapering or guidance, but not having seen tapering yet. You've seen gold now come down about 25% this year, 30% from the high in September 2011, and you have seen a number of investors sell out of what were overweight positions in gold at the start of this year. They've sold those down to a more neutral weight, or even in some cases sold out of gold. And you can see this in the ETF flows. We know that something like 750 tons now has come out of gold ETFs. So I think largely that selling has actually happened, and that is why gold is down 25%. It has already reacted to potential tapering and the potential rise in interest rates. And that means ultimately it comes down, the longer term picture for the gold price and the strength of the market, to me then comes down to the longer term drivers of gold in the next 3 to 5 years. What's the supply side look like and what does the demand side look like? And without going into a lot of detail on that, we still see gold being in a deficit in the long run, so the price is going to be strong because there's not enough supply.
Well, Marcus, thanks so much as always.
Thank you.
That's what's happening here in commodities. For the Street at the NYMEX, I'm Joe Dell.